All right, what is up, everyone? So today I want to talk about three things that we keep hearing a lot of buzzwords out on the media, social media, and that is rates, real estate, and recession, and kind of how all three of those go together and what the real meaning of everything that we're seeing is, as well as kind of what we can expect to see into the future. So let me get right into it. I'm gonna go ahead and share my screen here. Rates, real estate, and recession. What does it mean, and what can we expect? Let's look at some things that are affecting mortgage rates. Number one, inflation. Number two, the Fed hikes and the balance sheet runoff. And then number three, recession. Let's talk about inflation, right? Right now, we are over 8% inflation. That's high. It's the highest it's been in a long time. This is definitely negatively affecting interest rates because you got to think about it from an investor standpoint. People that are investing in mortgage bonds, those are fixed rates. And inflation means your dollar does not go as high. So the only way to combat that for investors is to increase mortgage rates to catch up to the inflationary rate. So that's why we're seeing mortgage rates get higher due to fears and actual higher inflation. So that's something that I think is important to understand because that is one of the major causes of it. And then we also got the Fed rate hikes. I'm going to go a little bit deeper into this. I'll talk about what that means, as well as the balance sheet runoff. And then finally, recession. That's a scary word sometimes, but I think it has. I think there's a lot of misunderstanding as to what it means. Let's get into this first here. So let's take a look at the Fed history. If we go all the way back to the 1970s, when Burns and Volcker were the Fed chairs, inflation went from 7% to 14%. And mortgage rates went from 12 to 18%. So yeah, not too bad about our 5-6% right now, right? But we saw a major increase right back in the 70s. So what did the Fed decide to do? Well, they got pretty aggressive and they raised the Fed fund rate from 11% to 20%. In response to that, again, this took a couple of years, inflation went down from 14 to 5. So they did a really good job of it. And then with the mortgage interest rate response, rates went from 18 back down to 12. There's always a consequence of this, and that was the recession. So as you can see, the S&P was down 30%. Stock market took the biggest hit in this particular scenario. Fast forward a little bit, back when Alan Greenspan was in charge, inflation went from 1.7 to 3.5. And then mortgage rates, same thing, increased. You guys see a pattern here? They went from 7% to 8.5%. So what did the Fed decide to do? Well, they raised rates again. They raised them from 4.7 to 6.5. And in response, inflation went down to 3.5 to 1%. And once again, mortgage rates also went back down. Check this out, from 8% to 5.5%. Because of how drastically they changed it. I mean, that was a pretty big jump percentage-wise. And so rates actually dropped even further than where they were initially. Now, again, a consequence of this was the S&P went down again. We saw stock market, take a hit and push the country into a recession. But again, a recession does not mean housing market. A recession means an economic slowdown. Now here we are with Mr. Jerome Powell as our current Fed. Inflation has gone from 1.5 to 8.5. That is a monster leap, guys. This is why we are all feeling it. And obviously, mortgage rates went from the 2s up to the 5s, and we're even into the 6s now. This data is about a month old, so just keep that in mind. We had the Fed fund rate at 0%, and now we've raised it to 3%. It's actually a little bit higher than this now since that 75 basis points. So we're at 3.75. And in response, we're not there yet because we're still early. We're hoping this will drive inflation down. And again, we are also hoping that this will decline mortgage rates. But again, we're probably going to see some sort of recession. It honestly looks inevitable from our point of view right now. Let's take a look at my slide's a little cut off here, but it's the Fed rate hikes as well as the impact of the Fed sheet runoff. So let me explain the difference to that. So a Fed rate hike is just what we talked about. They raised the Fed rates to go higher. The runoff means that they're not buying as many mortgage-backed securities. So the Fed is not investing their money in those mortgage-backed securities. Check this out. These are the mortgage-backed security, guys. So mortgage rates went down. And then same thing, started to go back up. The Fed hiked their rates 25 basis points. And keep in mind that this is back for starting in 2016. So this is a few years ago, but I think it's important that we study the pattern of this. The Fed hikes their rate, mortgage rates go down. Fed hikes the rate, mortgage rates go down. Fed hikes again after a little bit of a Took a little bit longer on this one, but then they went back up. In this scenario, when they hiked, rates went up because of the runoff. So this is where they stopped buying less mortgage-backed securities. And that caused it to go higher. But same thing, as they push that Fed rate hike and it runs off, we see mortgage rates get higher because of this balance sheet. You can see that very clear difference right there. And then same thing, you start another hike down, hike, whoops, and then down. And then same here, runoff slows, runoff stops. You guys can see this pattern. So I think it's important that we understand the consequences of when the Fed does certain things. When you hear in those reports that they are hiking rates, that's good for mortgage rates in most scenarios. But on the flip side, if they're not going to buy as many mortgage-backed securities and they're going to let their balance sheet run off, we can expect rates to get higher. All right, now let's take a look at these inversions. So what this is the difference between the 10-year Treasury minus the 2-year Treasury yield for the past year. So if we see, right now it's gotten a little bit backwards because obviously the more time you have your money, the less risk, you should make more money, but that's not the case right now. As we can see, it's become inverted. You see that little red line right there? So that's important. Take a look at this. If we look back through history, every time that has happened, it has pushed us into a recession. These are the 10-year minus the 2-year Treasury yields in the green and red here. And then these gray bars are recessionary periods. So it, like clockwork, every time it becomes inverted, recession, and then brings us back to the positive. Becomes inverted, recession, brings us back positive. Inverted recession, inverted recession, inverted recession. I mean, you can see that. And this is even the COVID one here. It came in inverted right before COVID. And then same thing, pushed us into recession. And we are, check it out, another inverted line here, which means we can expect to see a recession. Unemployment rates and recessions. So same thing. We got to look at these patterns, guys. Look at the history. Right here, we have unemployment rates. Every time the unemployment rate goes down, we see a recession. And then same thing, employment jumps back up. Unemployment rate down, recession fixes it. Down, recession fix. I mean, boom, 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 over and over and over. And here's where we are today. Check this out. We have unemployment rate at an all-time high and now at an all-time low, which means pretty much inevitably we're going to see some sort of recession coming. Now, how does this affect mortgage rates? When we enter a recession, check this out. Boom. First time this happened in 1980, rates went from 16% to 11%. Happened in 82, 18 to 13, 90s, 11 to 8. You guys see this? Are the numbers getting higher? Are they getting better or worse? They're getting better. So recessionary periods are actually good for mortgage rates. With this most recent one, that's why we saw, rates in the 2s and 3s because we were in a recessionary period due to COVID. So here we are again, and I think we can expect to see mortgage rates come down as we enter into this recessionary period, or a better word for it is an economic slowdown. Here's the interesting one. This is the one that trips everybody up because we have a short memory. The housing stays strong through recessions in every single case, except for one anomaly, which was the crash of '08, because the housing crash caused that recession. But every other time, housing has remained strong through recessions. You see those little curves up, curve up, curve up, curve up, big curve up. This is the only one where it went down. So this one here is the anomaly because again, we had a housing bubble. If you look at this most recent one, we saw a massive steep up, and I think we will continue to see home prices and home values remain strong through the recession because again, 1, 2, 3, 4, 5, 6, 7, 8 out of 9 times, that's what's happened. Again, this was the anomaly. This was the one-off. So when you think recession, you should not be thinking housing crisis. It's the other way around in this particular scenario. Now let's take a look at this. This is why, guys. So if we look at inventory, let's go back to 2007. This is when there was a ton of homes on the market, lots and lots of homes. And what drives home prices? What drives anything? Supply versus demand. So if we have a lot of something and not people are buying it, and again, had bad mortgage practices, we had fraud, there was a lot of things that contributed to the crash of '08. But this is an important one. This is where we're at now. We are nowhere. I mean, this is the lowest. The lowest home inventory's ever been, period. So that's an important thing to look at because, again, this is a huge driver of home prices. If we don't have enough homes to support the need for people, then we're going to continue to see home prices creep upward, even with rising interest rates. Now, the other thing to look at is the amount of people. So let's compare it to '08, right? We had super, super high inventory. Now we have super low inventory. Now let's take a look at number of households. There's still people being born. There's people moving out of their houses. We have a all-time high for the amount of people in the United States. There's 14 million more households and almost 3 million fewer homes. So, I mean, that's exactly what we're talking about. It's that supply versus demand. As you can see, there's a lot of people that need to buy homes and just not enough homes to make it happen. There you go, guys. I hope that was helpful. This is real data that we can use, that we can see as far as what we can expect to see in the future. So as another remander, interest rates are increasing right now, but as we enter into these Fed rate hikes, if they continue to do that and it successfully combats inflation, we will see mortgage rates go down. And same thing, we will see the real estate market continue to stay strong even through a recessionary period, which is more than likely coming later this year or early next year. So I hope this was helpful. If you guys have any questions, hit me up in the comments, and always looking forward to being able to help. Thanks a lot.